Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Gemma, welcome to this special episode on the Australian Finance Podcast.
Thanks for having me.
We are talking property as part of the summer series. And this time of year, people probably sit down, they've done their goals as per the first few episodes that we've recorded. They've started on a budget. And one of the big milestones in people's lives is property. So
that's a very common one.
Yeah. And it's not just first home buyers. It can be, families looking to upgrade. It can be retirees looking to downgrade, and so many other things. So we're going to talk about that, why it's important, and some of the key, points that people need to keep in mind.
Yes, I'm excited to get into this one because I think there's so many misconceptions about it, especially around how far away it is for most people on their journey. It always surprises me that it's generally a lot sooner than what people tend to think.
Interesting. There's a lot of media that's around the negative aspects of property and affordability, which is fair in some instances. Do you own a property?
I do. I don't own the house that I live in. I'm currently renting, but I have investment properties.
Does that mean that you're a rent investor?
I am. So this has been a strategy for a long time, but it's got, this buzzword, this new name around it, rent vesting.
Where you rent where you live and you own something somewhere else.
Yeah, exactly. So you're still in the property market, but it doesn't make sense for me right now, fresh out of a divorce and different things happening. It doesn't make sense for me to own the house that I live in. I'm in a rental, very happy there, low maintenance, absolutely love it.
Okay, that's good to know. I do own a home we bought during COVID. We only have the one property. There's no other property in our case. And happy we bought when we did. And happy we bought the house that we did. We're very grateful. So we'll talk a bit about that in this session. But one of the statistics that people probably aren't aware of, just how big the Australian property market is, I've got the number here. It's worth $10.4 trillion. So there's millions, then there's billions, and then there's trillions, just for people that are playing
trying to get their head around the zeros in that.
Yeah, there's a lot. I didn't even bother to write the zeros out. That would be I need more space in the spreadsheet. But that's huge when you put it in context. So the Australian share market, if you added up all of the shares on the entire Australian share market, like BHP, CBA, every single one of those shares is worth $3.3 trillion. So it's 3 times bigger than that. Mm-hmm. And there's a big reason for that is that a lot of people use debt to buy houses, but not as many people use debt to buy shares. So you end up with a lot of the prices in property being propped up by some debt as well as what we call equity.
Yes, and it's a lot more accessible to get a bigger share in a property because of that debt. Absolutely.
So why do we need to talk about this on the show? If we're doing this, 10-part series, why is it important? The reason that it's important is because you can't live in your shares, you can't live in your Bitcoin as much as you think you think it could solve that problem. It can't. And so you need to have a place to live. So this is where people, I think, Gem, get confused. They have an idea that property is an investment or a lifestyle asset. I think it's both. I think you can live in your property and make money from it, even if, as I'll explain, not in the house itself. So this is also, the reason that this is vitally important to everyone on the show is you have to make a choice, basically, therefore, whether you rent or whether you buy. Like you said, you don't have to live in the house that you buy. And the reason I say this is really important is because, one, you've got to live somewhere, but two, rent and mortgage stress is the number one stressor for everyone across the country. So I shouldn't say everyone, it's on average, 42% of the stress in households, financial stress, comes from this.
Yes, and it's one of the biggest expenses as well in our budget.
Yeah.
Like up there with tax.
Yeah, absolutely. There are things like groceries, but if you take the list, and I was looking at Finder's latest results for this, if you actually look at the signs of household expenditure and household stress, it's not just the mortgage itself that causes people stress. So in the top 10, we have energy, which is number 3. We have council rates, which is number 7. Number 8 is home insurance. So there's effectively 4 things in the top 10 that have to do with
your house.
With your house.
And I find that when people are looking at, so potentially they've gone to a mortgage broker and they've looked at what's the maximum that they can borrow, and then they're out there shopping for houses, they're getting really excited and focusing on the amount that they can borrow for the dream house or whatever. But they're not actually taking into account, well, what are all those extra expenses that I'm going to have with that? And then the little things on top of it that add up, like every time you have to go to Bunnings to get stuff, like you need to include all of those in your expenses when you're looking at how much your borrowing potential is, because it's not just about what you can borrow, it's actually what you can afford and what you're willing to pay so that you can still enjoy your life outside of all of those house expenses.
We bought a weatherboard shack in the hills a few years ago. We finished painting it last year, 18 months ago, and I'm looking at it now. I'm like, I've got to do it again.
Ready to do the next lap, yeah.
Oh, thinking to myself, oh no, here we go. The decking needs to be done twice a year. Like this time of year, it's hot.
This is why I'm loving my rental, because I've always lived in properties that I've owned for a very long time, and we've always renovated them. And so now I'm just looking around going, if there's anything to do, I just call the real estate. I love it.
So you're on the reverse side of it right now. So obviously housing affordability is a massive issue, and it's probably not just people that are buying. It's also people like if you're a retiree, you have to make a decision. I've got a lot of money, like effectively built up in my house.
Yes.
So I need income, but the money is in the house. So there's a pension, but then that is impacted by my asset, which is my home. It doesn't produce income. And so you end up in these sticky trade-offs through life. I feel like there's a few things that I wanted to say about this key point of property. And we do have a course on it. We do want to hear your feedback. I actually, Gem, you wouldn't know this, but in our property course that we did with Chris Bates and Amy Lenardi, I actually shared a video of my house going underneath the house, showing how to do an inspection. And you can see all of the, imperfections. Mm-hmm. And I think in that video I showed how when we bought the house, there was like a rug and the rug covered up like holes in the floorboards.
Yeah.
So, there's a lot of things that come with buying a house that you just don't realize, but there's also a lot of misconceptions. I think the first one is that you need a 20% deposit.
Absolutely. That's a big one.
Yeah. There are reasons for it, as we can talk about, but realistically, you don't need 20%, right?
Absolutely not. Like it depends on what you're eligible for in terms of different like state grants and different incentives, but also depending on your occupation, that might actually be less as well. And yes, for a lot of people that don't have a 20% deposit, they're potentially going to pay lender's mortgage insurance, which is a large cost that the bank lowers their risk. It doesn't protect you. But if that is getting you into the market sooner and that's a good decision for you, it makes sense with your financial goals and your financial position, then potentially paying that premium, getting you into something faster isn't always a bad thing. I think just like debt, we shouldn't be scared of lender's mortgage insurance. I think we should weigh up if it makes sense for the individual to pay it.
Yeah, I remember my brother-in-law, shout out to Tom, he was talking to me about this around the time that we were both like thinking about property and these types of things. And he's like, the property market could go up more where I want to buy than the cost of lender's mortgage insurance.
Yeah, then sitting on the sidelines for an extra 6 months.
If I had a time machine, he was saying, I would just buy it.
Yeah.
So that's why I'm thinking
And if you think
it.
like you're going to have that, well, if you're looking at property, whether it's an investment or to live in, generally you want to be holding that for 10 years, ideally minimum. Like if you think of that lender's mortgage insurance fee over how long you expect to hold that property and hopefully that there will be growth and you potentially are living in it. So that's your cost of living, like you're not paying rent potentially in that scenario. So I think you need to look at it in that sense, not in just it's a premium fee as a one-off. You need to really consider it in the long-term approach.
Yeah, agreed. So the reason why we say 20% just for everyone that's not 100% clear, that's because that's typically the limit where you don't pay lender's mortgage insurance, or LMI as it's called for short. So, but the key thing is it's not like 20% equals no insurance, 19% equals maximum insurance. It's a sliding scale. So in our property 101 course, Chris, a mortgage broker, talks about typically what he likes to see people get to is about 12%. It's kind of like this magical number.
Like a break-even type.
Where it's kind of like it starts to impact, but it's not that bad. The bank see it as, well, you've got a good savings habit. It's not that bad. So that's a myth. And if that gets you into a good property sooner, I think that's something that you should bust for yourself. And we also do have a Australian property podcast, which is devoted to property, 2 episodes a week. You can get that on your podcast player. Great resource. The second thing I'd say, more for first home buyers, but also for anyone, is buy once and buy well. And that's easier said than done because it's a competitive market.
Yes.
But the difference between buying a good asset for your first home and not is stupendous. It's either a springboard into a much better financial future, or it's something that maybe at best washes its face, like it just goes sideways. I hear a lot of people that buy what I would say poorly, I'll give you a counterpoint, is buying an apartment or something that's off the plan and not yet built. Not that they're always bad, definitely they can be good. But oftentimes when I hear bad stories, it's those types of assets that people are buying. I don't want to be like completely against that because that's fine, but for the most part, that's where I see most of things going wrong.
Yeah. And I think it's really important to understand that Australia has so many different property markets. So it's really hard to say like everything goes up or, you know, one area does really well compared to another because they're all these little independent markets that work really differently. So apartments and units might do really well in one particular area and not others. But I love the idea of buying once and buying well because it's so expensive to get into property in Australia, and selling comes with a lot of costs, buying, stamp duty, all of that type of stuff. So the longer that you can hold an asset, I think is usually the better choice. And if you're going to buy, say it's your first home, chances are that's not going to be your forever home. But if you can buy it with an investor hat on, going, yes, it suits me right now, but it would also make a great investment. It'd rent easy. It'll be low maintenance, whatever that looks like. That means when you're ready to, like you've outgrown it, you have the choice. Do you sell it or do you keep it as an investment? But if you buy it that just suits you and not actually the masses and not thinking of it that it might be an investment, you don't really have that choice. So I think if you're going to buy property, unless it's the dream home, you should always be thinking of it. Does it make sense for me right now, the trade-off, but also would it make sense for me to hold on to it if I didn't want to sell it or I couldn't sell it? That's
a really good point. One of the things that Chris has always impressed upon me, and Amy for that matter, over on the Australian Property Podcast, is when I say buy once, buy well, it's also don't try and buy heaps of assets. Like in the past, you would hear these stories like on a current affair, someone's got 100 properties. What you don't hear is 12 months later they're broke.
Yeah, I see them on Instagram all the time. Someone's just up to 137 properties. I'm like, I've got a couple and I hate hearing from the real estate agent.
Yeah, and I mean, there's things here that I'll come back to, but you're better off putting all your, in my opinion, this is not good diversification, but in my opinion, you're better off buying one good asset if you're a younger person or a professional, you've got a good earning potential. Buy something, because what you can see in the data is that land value appreciates dramatically. Building value doesn't always. So
that's true.
If you think about it, if you build a brand new house today, like my painting idea, the paint that I put on 18 months ago, if someone was to come and buy the house today, they'd be like, oh, I want to lick a paint on that. And so that's an idea that plays out across all of the market, which is typically the building ages. And so that's why we have something called depreciation reports if you're a property investor. But the land value can appreciate substantially if you buy in the right area. And we were very lucky we did. Amy talks about this. There's no rule of thumb, so I don't want to like misrepresent what she says. But she said something which was really interesting to me early days, which was like, if you can find a property where the land value is about 70% of the total property value, it's actually quite an interesting level if you think about it. So let's say, for example, I'll use round figures, but let's say, for example, a house is $1 million. If you kind of look at it and you go, what would this block of land sell for? 600,000, 700,000? that's around 60 to 70%. It's a really interesting thing because then the build cost would be, in effect, the building's worth $300,000 if you pulled it apart. And that was a really interesting idea for me.
That's a good way to look at it because people, it's really hard to assess what is good value and things. So I think if you have some like rule of thumb like that can be really helpful.
Yeah, and it's not like a house, let's be realistic. In major cities, buying a house with some amount of land is not possible. And it may be the case that you just can't do that.
Yeah.
And that's okay. There are other strategies available. But to your point about starting with the end in mind, I think one thing that helps is knowing who you are going to sell to. So even if you're planning to live in this house, who you sell to dramatically changes what type of property you go for, what type of house it is, if it's a house or an apartment. For example, Chris would tell me, well, if you buy this house, imagine that you're going to sell it to an upper middle class family. And they would probably want 4 bedrooms because there'd be 2 kids, parents, and an office. Mm-hmm. Right? They'd probably want north facing, so they get a bit of sun. They probably want to not be on the busiest street. The reason why you sell to them, Gemma, he says, I'm curious to get your thoughts on this, is because they're the most emotional buyers.
Yep.
They're buying their forever home. You're selling to the person that sees it and it's like, this is it. We are in. And they go to the auction and they go wild.
And they're willing to pay more.
Yeah.
Yeah.
And so that, I don't know if you've ever thought about something like that.
Yeah, I definitely think, and I kind of go, well, if you are buying a property, you also, like if I'm putting my investor hat on, I want to appeal to the masses. So who's actually living in that area? So is it families or whoever? And is that property actually going to appeal to the masses? So that's what I would be focusing on as well.
Amy talks about a property brief in our free course. And so what that is you basically, if you're in a relationship or you're buying as investors, you basically just put down like 3 to 5 things each that is really important to you, like kind of like these are the most important things.
Like your kind of non-negotiables.
Yeah, and then you have your negotiables. So maybe the negotiables is 2 toilets or 2 bathrooms.
Yeah.
But maybe a non-negotiable is 3 bedrooms minimum.
Yeah.
Because you're planning for a
and
family,
it might be
whatever.
a garage or room for a shed or something.
If you're a tradie,
you have to have that. Yeah.
And so those you have like a list of non-negotiables. And what you're trying to do then is trying to map that to also the areas. Maybe the area is a non-negotiable. But if you have that written down, over time you might begin to realize, hold on a second, we're not going to get that in our market because everything seems to be going above that. Like it's just not going to happen. The final thing that I'll say is on the buying front is get in touch with your broker ASAP.
Yes.
Like you said before, people don't always realize.
They think it's further away than it is. And that's like a conversation you can be having about the LMI, right? Like the lender's mortgage insurance. You could be thinking, actually, I'm prepared to pay that or not. But yeah, the conversations with your broker should be pretty much as soon as you've got the idea that property's on a goal so that you can then know, well, what do I need to be earning? What do I need for my deposit? And then you can map out your goals and how long it's going to take to get there.
Yeah, in the previous episodes, we talked about like your mindset, your values, your budget. These are the things that get you there. Like we also talked about debt being like buy now, pay later. Even though, quote unquote, not debt, it is because the banks will take it off your borrowing power.
Yes.
They'll take credit cards off your borrowing power. Your HEX will also be impacting, even though I don't consider that a really bad debt.
But yes, the banks
adjust for that, yes.
And so this is what the broker can be talking to you about. They can be saying, well, make sure over the next 3 months or 6 months you're doing this with your finances, you're this, you're that, and they're just helping you in every way make sure that when you're in the position to buy and lend that you're you're the strongest candidate. And
another thing on that is like, so they're saying like, yeah, you can, as in be a strong candidate. You talked about income in one of the previous episodes. One of the key things to note is that the house that you might be buying, you might be thinking of buying, or the area might be unaffordable. But one of the things that debt does is it kind of multiplies the amount of money you can spend on something. So instead of spending $100,000, you're spending $400,000 because that's your deposit versus your whatever. The key thing is, and Amy talks about this quite a bit, is it's not necessarily what you're earning now. It might be what you're earning in a year. And all you've got to show the banks is like earning capacity, pay slips, that sort of stuff. So if you are speaking to your mortgage broker early, what they might say is, could you change jobs?
Yes, exactly. They're going
Could
to
you earn
help you
more?
with a plan. Or, potentially they can put forward a case going, well, you are going to rent a room out or you are going to do this. And they're putting together a case for you to go to the bank and say, this is the reason why this person can support this loan.
We never would have got our house without two things happening. COVID, not predicting that's going to happen again anytime soon. But the second thing that wouldn't, because we are business owners, well, I am, my wife's not, the thing that allowed us to buy the house was something I'd never even heard of. And the mortgage broker, being Chris in this instance, knew about it. He said about 10% of banks might offer something like this. Let's see what they say. And it's like a common debt reducer loan or something like this. I can't remember the exact phrase because I hadn't heard of it before. And basically it meant exactly what you're saying, is that like you can prove to the bank that such and such expense, or you might rent a room out or something like that. And that drastically impacts your borrowing capacity because you're saying, yeah, my expenses are this, but they're not going to be because of that.
Yes.
It's not just
Or this is
cookie
this is gonna change. Potentially you're not saving a lot right now because you have high rent, but you're gonna move in and the friends that you're living with or whatever. This is the value of speaking to a broker as well, because when you walk into your bank and people go, I'm loyal to my bank, I'm gonna talk to my bank, they have specific rules. Whereas when you go to a broker, they're looking at all of the bank's rules and working out, well, which ones suit your situation for your earning, your expenses, where you want to buy. So the value of a broker, like it will significantly change the options that you have.
The good thing about brokers is they're like accountants. They're not like us, Gemma, where we are in quote unquote finance. Brokers are in a different type of finance, which I'll explain in a second. And then accountants are in a totally different world too. You can pick up the phone, call your broker, call your accountant, and they can say, yeah, Gemma, that's a good idea for you. And that costs them nothing, and there's no red tape, there's no compliance. But if you tried to ask us that on the phone, we would be like, well, we're going to need to do
it depends, and I've got to put it in writing. And
got to do a risk profile, and it's going to be a few $1,000s because I've got to pay everyone to analyze this.
Yes.
But you can call them. It's free. Call your broker, call your accountant, say, hey, I'm thinking of buying a house in the next year. If you're still doing your tax return, speak to your accountant when you go to see him and say, hey, I'm thinking of buying a house in the next couple of years, or I'm thinking of upgrading, downgrading. What can I do? And this is really important as we transition from just talking about first-time buyers and being in the market to investors and homeowners. Mm-hmm. Your broker becomes a superpower and a super asset when you start to do things like debt recycling, when you do things like equity release, when you use your property for security. So for me, Gemma, one of the things that we're doing is using our house for a loan, but that loan is not for property, it's for investments.
Yeah, so your debt recycling.
Yeah, and we can...
And your broker's so strategic as well. Like when you try to do this stuff on your own or you direct your bank, like you actually want somebody there confirming your strategy and how it works. And there's a reason these are professions, right? There's mortgage brokers and accountants who can help you get this right.
Absolutely. And so you can do this stuff yourself. Like I tried to approach ING when I went for my loan, and instantly they were the bank that I banked with. And so they pulled it up and they're like, oh, probably not. And I was like, oh, okay. But going through someone who understood the mechanics of things and could massage applications in the right way, it made a lot of sense. And so like we're in this stage where we did an episode last year, Jem, which is about potentially buying a farm. And that's kind of like, it's probably been put on the back burner. Mm-hmm. Just because there's what you can borrow and there's what you should borrow.
Yes.
There's what you can buy and what you should buy.
Yeah.
And
one of my favourite sayings is just because you can doesn't mean you should.
Yeah, there you go. And for us, we could have done that, but that would have been a lot of stress. This 42% that Finder's saying is causing household stress, it would have been a lot higher for our family. It would have been all of the stress. So, we could do this, and that's probably a warning sign to anyone that is buying a house is you go into the mortgage, like the borrowing power calculator. It's going to tell you what you could borrow because the bank wants you to borrow the maximum. Doesn't mean you should.
And you need to think about what that's stopping you doing. So if you were to borrow that maximum, is it stopping you from doing the next thing? Or is it stopping you from doing things that are important to you, like an annual holiday or putting money into your super for retirement or potentially getting ready to buy the next property that might be an investment? Just because you can do something right now doesn't mean that it's always the best option, and as it might be, the knock-on effect might be huge.
Yeah. There are many ways that people go wrong in property, and I think what we're advocating for in this episode is just speaking to experts. If you call a broker or you call someone and they don't live up to your expectations, be very quick to move on. Pardon me, it would be my opinion.
Yes.
Don't think that like it's you. Just go to someone else who will answer your questions. Get the right answer, because that's been my experience in the mortgage broking profession. Even with accountants who are stuck in their lane, so to speak. I don't mean any disrespect. I just mean that some do one thing and they don't do any of the other stuff.
Yes.
So shop around, get someone who's had experience with property, with debt recycling, if that's what your strategy is, or equity release in my instance, because it does make the difference.
Yeah.
For them to be like, yeah, we've done this 100 times this year, and here's what you need to do.
And you need to be really comfortable with this person. It's like where you see a financial advisor or whatever, like you probably want to speak to a few. So you find someone that has the experience, but you also get along with, you can be a team, because it's going to be a lot of back and forth. It's like you're going to build a relationship with this person. So you want to be really comfortable with them.
Yeah.
And like we said in another episode, it's okay to outgrow them as well. You know, if they got you in your first home, but now you're taking things up to the next level, it's okay to outgrow that professional and move on to somebody who's now right for you.
Absolutely. So if you're buying your first home, go and check out our free course. We've got the podcast, obviously. We've also got links to mortgage brokers, money coaches, anyone, financial advisors that can help you on that journey. But start early. I'd say if you're already in a home, if you're thinking about investing or just using your property strategically, I think the biggest opportunity for most people who already own a home is to use your equity in that home. It is a superpower. I know you probably don't want to see a big nasty debt line in your bank statement, but the reality is using your property effectively, whether that's to invest or debt recycling or something, is a superpower. On a spreadsheet, it's fantastic. It doesn't mean it's good behaviorally, but speak to probably accountant, financial advisor for that, maybe your mortgage broker. We've got links to a podcast that's covered that specifically. So, Gemma, this has been heaps of fun talking about property. The next episode is talking about super, which is really your jam.
That is. I could talk about super all day.
Okay, so that will be in the next episode. And if you do have any feedback for us or you want to ask questions, episode 11 of the summer series is all about answering your questions. Hopefully we're going to do a bit of a review of someone's bank statement and see what happens. But please send us anything that you like. You can send that via the link in your podcast player. It says ask a question. You can also just use that for feedback or getting in touch or saying something funny. Funny in name, the better. We'll be back in the next episode talking about super. Gemma, thanks for joining me.
See you then.
Thanks for listening to this episode of the Australian Finance Podcast. This series is sponsored by Betashares, one of the leading providers of ETFs here in Australia, having reached over 1 million investors through Betashares ETF range. The company's been around for quite a while, and I'm very proud to say they're a partner of ours here on the Australian Finance Podcast. What I'm going to do now is give you a very quick overview, a rapid take on the Betashares S&P 500 Equal Weight ETF. As always, you can start by breaking down the ETF's name to understand what you're getting if you invest in QUS. That's the ticker symbol for this ETF. Betashares, a leading provider of ETFs here in Australia, one of the biggest providers indeed, and by number of ETFs, the largest. So we know Betashares. The next thing, S&P 500. The S&P 500 is the predominant and premier index in the United States, probably the most common, right beside, I should say, the NASDAQ 100 index. Now, you're probably familiar with the NDQ ETF from Betashares, which is their most popular ETF, but this one, focusing on the S&P 500, includes around about an extra 400 companies, and it takes companies from across America, not just the NASDAQ stock exchange. So there's also the New York Stock Exchange on there, for example. This is where things get interesting from this point on with QUS. So unlike a traditional index fund ETF or just an index fund, which is weighting the companies inside of the ETF by the largest company getting the biggest size, with this ETF, what you get is equal weight. And so as you can imagine, this is like having all of the shares inside of the ETF in proportion to each other. Whereas with a market cap or a traditional index fund ETF, like say NDQ for the NASDAQ 100, the largest companies like Microsoft, Tesla, Apple, Nvidia, these types of companies get a bigger share of the overall pie that is the ETF. Now, why would you use one, which is an equal weight, which simply puts all of the companies inside the ETF equally, versus a market cap weighted ETF or a traditional ETF,
which has the largest companies by total value of shares. There are a few reasons why you might want to consider these two ETFs together rather than have one or the other. But if we just focus on equal weight, imagine that you had $500 that you could spread amongst 500 companies. There are some smaller companies that are also going to be invested in, and they'll have $1, just like the biggest company, like say Apple or something like that. Now, if you take a market cap weighted approach, you still have $500 and you still have 500 companies. The difference with that is that the biggest companies might get $10 and the little companies might get 10 cents. So by mixing it to be equal weight, what you're effectively doing is taking money from the biggest companies and spreading that amongst the smaller companies. So you can start to see how this is changing the overall ETF. For QUS, you end up with more invested in the smaller and mid-sized companies and less invested in the large-sized companies relative to a normal index ETF. So you're probably asking, well, what does this mean for my investing? With QUS, what it means is you're getting exposure to a more diverse range of companies by using an equal weight approach. So why would you want to do that? In recent years, we've seen some of the largest companies in the United States and here in Australia really power ahead. We've even given these companies names or phrases like Mag 7 or FANG. We've seen companies like Microsoft, Tesla, Nvidia, Apple, and so on power ahead as their global technology takes a hold and starts to increase prices on their consumers and customers. But what about the other companies? The companies that are still growing and emerging and could one day be those companies? By using an equal weight approach, effectively, we're adding more to those. So you can see, or you can get a sense that we're probably going to capture more of the long-term growth from those smaller companies, while also keeping in mind that once they get above a certain percentage, they will be trimmed. But you can get some exposure to those mid-size and smaller size companies, which are still pretty big, to be honest with you, earlier on. And I'll give you an example. At the time of recording, I've got it right here in front of me. Amongst the top holdings in this ETF, even though they're equal weight, they still fluctuate up or down between the rebalance dates. We've got Palantir, Tesla, United Airlines, Tesla, Carnival Corp, and Lululemon. Now, you're probably thinking, I know pretty much all of those things. If you're not a tech person, you probably don't know what Palantir is. It's one of the world's leading data and intelligence companies with software and all types of things. Tesla, you know. United Airlines, one of the world's leading airlines. Tesla, you know, it's one of the largest companies. Carnival Corp, it's a cruise liner. Lululemon, an athletic wear business that's a super premium product. So by using an equal weight strategy, you're getting more of those other names inside your ETF. And that's where QUS comes in. So how would you use an ETF like this? You could use it in a few different ways, but one of the common ways I see an equal weight strategy being used is alongside another ETF, which is a traditional ETF, or even potentially as part of a satellite allocation where you think, you know what, those big companies, I'm not as convinced about them. Maybe I want a little bit invested in small and medium-sized companies through something like this. I should be very clear. When I'm saying small and medium-sized companies, I'm only saying relative to the massive technology companies. The S&P 500 includes truly huge companies, over $100 billion US market cap. So even though I'm saying they're somewhat small or medium, that'd still be the biggest, if not some of the biggest companies here in Australia. The ETF itself has a pretty low fee of 0.29% per year. And interestingly, there was a stat here that in the 30 years to June 2024, the equal weight index had performed as good as the normal index, so the S&P 500 with market cap weighting. And that's really interesting to me because it's not always the case, but it illustrates that sometimes you can mix two ETFs together or have a different weighting strategy, and you can still end up with a pretty good long-term return. So this ETF brought to you by Betashares, it's QUS is the ticker symbol. I would highly encourage you to go and check out the product disclosure statement, that's PDS for short, and the target market determination, that's TMD for short. Both are available on the Betashares website. And as always, don't forget that investing involves risk, and you should speak to a licensed and trusted financial planner before acting on this information.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.